All right, let's talk about one of the most interesting earnings reports we've seen this season. It comes from NeuroOne. On paper, the numbers looked absolutely fantastic. But the way the market reacted, well, that told a totally different story. And it's created this fascinating paradox that we really need to break down.
So here's the big question, the real head-scratcher. How on earth does a company report a 907% jump in revenue, beat the earnings estimates, and then watch its stocks sell off? That makes no sense, right? Well, that's exactly what we're going to figure out.
Okay, first things first. Let's look at the actual results from their pre-market announcement back on December 17th. This is where the whole story gets started, and honestly, the numbers themselves are pretty incredible.
I mean, get this. The number that just jumps off the page is this one, a 907% increase in product revenue compared to last year. It hit $2.7 million. That's just explosive growth. There's no other way to describe it.
And it wasn't just about sales. NeuroOne also beat expectations on the bottom line. They posted a loss of 3 cents per share, which was actually a penny better than the 4-cent loss Wall Street was bracing for. And in this game, losing less money than expected is definitely a win.
On top of all that, they showed they're getting healthier as a business. Their product gross margin went up to 55.8% from about 52% a year ago. What that tells you is that as they're getting bigger, they're also getting more efficient. And that's exactly what you want to see.
Okay, so here's where things get weird. The market's reaction. With all that great news, the stock shot up almost 7% before the market even opened. Made sense, right? But then, throughout the day, it just bled out and actually closed down more than 5%. This is the paradox in action, a total head fake.
So to really understand that huge disconnect, we have to look past the raw numbers and dig into the story that management is telling investors. Let's unpack how they framed not just the quarter, but the entire year.
And the CEO, Dave Rosa, he did not mince words. He called 2025 an inflection point. In his mind, this isn't just one good quarter. He's saying the entire direction of the company has fundamentally shifted for the better. And this table right here, it shows you exactly what he means. They got that massive 900% revenue growth, while at the same time slashing their net loss by more than half. And the real kicker? They actually reduced their operating expenses. That is the definition of scaling smart.
So what's the magic behind this so-called inflection? Well, it really all comes down to their huge partnership with Zimmer Biomet, who's handling the rollout of their OneRF brain system. That deal, plus a recent fundraise, means they are now in a really solid financial position. We're talking over $6.5 million in cash, zero debt, and enough money in the bank to last them through the 2026 fiscal year.
Okay, so the recent past looks great, and management's story sounds really compelling. But you and I both know the market is a forward-looking machine. So let's weigh what's coming down the pike, the good and the risky.
Now, this timeline shows some really great momentum. You've got a recent FDA clearance, you've got the first patients being treated successfully with a new therapy. That's all fantastic. But then you see that third item, a NASDAQ compliance deadline. Basically, they have until May of 2026 to get their stock price to stay above $1, or they risk getting delisted. And that kind of risk, it can hang over a stock like a dark cloud.
And that really brings the whole debate into focus, doesn't it? It's the bull case versus the bear case. The bulls are looking at the fundamentals, this amazing partnership, a growing pipeline, better financials. The bears, though, they're focused on the structural risks, that delisting threat, being so reliant on one partner, and just the wild volatility that comes with being a microcap stock. On earnings day, it's pretty clear the bears won that round.
So, what's our take? How do we put all this together and look to the future? Well, that brings us to what we call the next call.
Here's our thesis, broken down into 3 steps. 1, the observation. We think the market is getting way too caught up in those microcap risks, like the NASDAQ listing, and is basically ignoring the incredible acceleration happening in the actual business. 2, the catalyst. Management is waiting on a forecast from their partner, Zimmer, before they issue official guidance for 2026. We believe when that guidance finally drops, it will be the wake-up call that forces the market to look at the growth story again. And 3, the conclusion. This gap between the strong business and the weak stock, well, that could be a real opportunity.
Now, to put that thesis into the formal language of equity research, we have to assign a rating. And in this case, our rating of outperform means we expect the stock to do better than its peers and better than the overall market over the next year to year and a half.
So there it is, our rating on NeuroOne is outperform. Despite that bizarre sell-off after earnings, we believe the fundamental momentum, driven by that all-important Zimmer partnership, is the real story here. And eventually, we think the market is going to catch up to that reality.
So what's the big takeaway from all of this? The NeuroOne story is just a classic Wall Street battle. On one side, you have powerful, undeniable growth in the business. On the other, you have these very real risks that come with being a small company. That strange stock reaction after earnings perfectly captures this fight, and it leaves us with one big question. In the long run, which side is going to win?
And of course, as always, please remember this analysis is for informational purposes only. This is not financial advice.